This is John Dunleavy at Monorail. Here's 5 ETFs that I think you should look into. The most simplistic approach would be to focus on 3 that across different sectors of the market. One will be a broad US exposure, essentially owning the haystack approach. And that would be ETF like VTI, that is Victor Thomas India. That's a 3 basis point fee, and it covers a complete US exposure for US equities. Along that same vein, if you wanted to do an international exposure, I wouldn't recommend a heavy international exposure because I would rarely recommend anything above 15% for international exposure, just because there's so many variables that are hard to track when you go overseas. That is a whole different regulatory system, a whole different accounting system. And the markets are substantially smaller. That is, the US comprises like 65% of the global market. So when you start investing in different parts of the world, the markets are much smaller. But in any event, staying with the same Vanguard family, there's an ETF called VXUS. That's got a slightly higher fee, I think 7-8 basis points. And then to complete the thought, you could do a US bond portfolio, and the most famous really is the BlackRock ETF, is the AGG, as in AG. Now the AG index, anyone that remembers, that was originally the Lehman Brothers index, and it became Barclays, and then it became Bloomberg Barclays, and now the ETF is under BlackRock. A couple more I would throw out. There's a new ETF for the Magnificent 7 stocks that everyone's been talking about both positively and negatively in the last few months, and that's MAGS, as in MAGS. And then finally, another sector of the market that I personally like, the AAA segment of the CLO market, and that stands for collateralized loan obligations. That's a market that generally wasn't really available to retail investors until recently, until the ETF came out with some of these products. That used to be only an institutional market, so retail investors were shut out of that. But that ETF is called JAAA, 3 A's, and those only invest in the very top component, or the highest rated component of CLOs. Now, these are bank loans that are divvied up into credit slices, and these are the very top. And bank loans are higher in seniority than corporate debt is. So it's really the top of the capital structure, and they have very high recovery rates. Consequently, the credit risk is low. This JAAA ETF is yielding like 6%, which is a very attractive level for this particular risk return.